we have talked about in video one, which business to buy, in video two, fiscal and financial due diligence. And in this video, we're going to be talking about getting the deal done, structuring that deal so that it makes sense for you as you buy it. And there's a lot of detail here. I'm going to jump in and talk about all the different components of structuring the deal because it makes sense and it can make a determination on whether or not you're successful once you acquire the business. So when you're talking about deal structure, you're really talking about two main components. The two main components are price and terms. Now, there are other things we're going to talk about like financing and cash and all of those kind of things. But the two main items in deal structure are the price and the terms. So what is price? That's very obvious. Price is what you're paying for the business. So it's the number that you're agreeing to take on the acquisition of that person's business. And the terms determine whether it's a painful or a profitable acquisition that you make. The terms are things like how long you have to pay it back, how much interest you're going to pay, how much down payment you're going to make, what is the term of the loan that's going to be taken in order to do that, well, how much the owner is going to be involved. Those are the terms that are going to be the most important as you negotiate your deal. So you can often you will often pay a higher price if you have better terms. In other words, if the owner says that I'm going to carry the deal for 10 years, you only have to put 5% down. I'm giving you all of my time and attention for the next 6 months, and you don't have to pay me a salary for that. All of those things are related to terms. If the terms are really good, typically it's going to require that you pay a higher price. A lower price with cash up front could be a structure that you put in place if you were to have worse terms. So you need to pay it in 3 years, or you need to pay it in a year, or the owner doesn't have to get involved and he's just walking away. So terms are important, and you need to understand what those are as it relates to the acquisition of your business. Now, here's the deal. A mentor of mine told me this a long time ago, and it's proven to be true in my history, that you can either negotiate for a better price or better terms, but rarely do you get both. So almost never do you get the terms that are favorable and a price that is favorable. So you need to understand that one is a function of the other. In order to get better terms, you're going to pay more. In order to get a lower price, you're going to have more restrictive terms. So just understand that. So price and terms are what you're negotiating with your client and with your seller. And so what about how to structure this deal? There are several different ways. The first one is owner financing. This is very common in small business acquisitions. It can be very challenging to get a loan for a small business acquisition. And so many times the seller, because of the dollar amount that we're talking about, will just simply finance the deal for you, ask for some down payment up front, and then put the remaining balance on a term note that you pay over a short period of time, and the owner is actually acting as the bank for you. Now, what are the advantages of this? Well, it shows that the seller has confidence in this business. And so when they're willing to carry the financing for you over a period of time, they know that the business is going to be around, that it'll be very difficult for you to not make a profit. The other advantageous situation here is that it reduces your upfront cash requirement. When an owner is willing to finance for you, you can get it for as little as sometimes 5 or 10% of the overall purchase price down. And that allows you to have less cash up front so you can put more cash in the deal as you go. So owner financing, very, very advantageous, so easy to do. And many owners these days are wanting to carry that contract to take advantage of a delayed tax situation. So really, that's a kind of a side note and a negotiating point for you. If you pay an owner their business all cash up front, they are having to calculate their taxes based on the gain of that business at the day they close. If you pay them over time, they're only paying taxes on the amount that you pay them in each given year. Consult your CPA for specifics on this strategy, but it can reduce the seller's tax liability if they're willing to carry the contract for you. So owner financing is number one. Number two, this is also very powerful. The Small Business Administration has what's called SBA financing for business acquisitions. Now, this will require somewhere between 10 and 20% down. It gives you the ability to stretch your payment out over 10 years. It does require that you have solid financial information, and you are going to have to talk to a bank that gets SBA approval in order to put that deal together. Now, SBA financing is powerful. There's two programs. There's the 504 and the 7A. In those deals, it really is determinant whether or not you're buying equipment or real estate or what kind of project you're doing, which will let you know which category, the 504 or the 7A, you are putting this loan into. Banks are the portal to getting an SBA loan. You don't go directly to the SBA. You go to your bank and you talk to them about an SBA loan for business acquisition. They are done all the time. It's going to require that business has performed well over a period of time in order for you to acquire an SBA loan. But listen, it is a very powerful way to purchase a business, and you want to seek that out if it makes sense. Cash and investor deals. Now, this is probably the simplest of all structures because you are simply writing a check or getting an investor to help you write a check. It's faster, it's simpler, and it also gives you amazing negotiation leverage with the seller. Because the seller, if they're motivated to get their cash out, will be able to do that in one transaction very fast, and they don't have to carry a contract and take the risk over time. So important. It's such a powerful tool if you can use cash to purchase your business. Now, how long do you have to pay this back? So let's say you use owner financing, an SBA loan, or I didn't talk about this, but a traditional bank loan, which most banks don't lend for acquisition purchases on a conventional basis. They almost always use the SBA. But let's say you were able to acquire a conventional loan, an SBA loan, or owner financing. Well, how long are you going to pay this back? Well, the standard is between 36 and 120 months. So you will be making payments for 3 years to 10 years on that business as you go. Now, the longer terms, if you can get it to 120 months, that is so good because it allows you to create better cash flow. So, because imagine you're stretching that payment over 120 months, lowering the burden of that debt service or that payment that you need to make, which allows you to strengthen your cash flow and really make that business profitable. Shorter terms will be a better overall cost for the financing because you're paying less interest on a shorter period of time, but it can be a little challenging with cash flow because it usually means a larger payment. Now, if you want to talk to me and reach out individually to me about how you can structure these loans, there are some combination loans where you're making small payments in the early part of the loan and larger payments at the end, but I can talk to you about that in detail if you would like some personal information. So that's the way you finance it and how long you're going to pay for it. Now, can you buy a business out of profit? Well, this is a very smart structure for buyers to structure the acquisition of a company. So what it says is, listen, Mr. Seller, I would love to buy your business for $100,000. What I'd like to do is give you $10,000 down and pay you out of the gain and profit that we make over time. You can even increase the sales price of a business to allow that seller to be comfortable with paying out a profit. It allows the seller to get more for their business and allows you the benefit of paying out of profit instead of paying on a monthly basis. So you're not using your personal cash. You're not investing a tremendous amount of cash up front because it's based on the business's earnings. And that is a powerful tool in negotiation when you're trying to acquire a business. So that's the structure. Now let's talk about exactly what you're buying, because you want to make sure that you do a good job of detailing all of this in the agreement that you make with that seller. So what are you buying? You're typically buying inventory. These are products that have been put together on the assembly line or assembled in the factory or put together in the yard that are ready for sale. Inventory represents product that you have that is ready to sell, and it's got a value associated with it. Raw materials are also going to be in the company if it's a manufacturing style company. So raw materials are the materials that you use to assemble to create the inventory that you're going to sell. You're probably buying accounts receivable. So accounts receivable represents money that people owe you for sales that have been made. And so there's going to be a number on the financial statement that it's called AR or accounts receivable that you're going to want to identify because that's money that is owed to the company. Another thing you're going to be buying is equipment. So maybe there's a line, equipment line that is there that that's putting together and assembling the product. Maybe it's lawnmowers, maybe it's trucks, maybe it's excavators or backhoes. So you're going to want a list of the equipment that the client owns, that the seller owns, that you're going to be and putting a value on it. And then that will be represented in the purchase price of your business. Another thing you'll be buying is websites, phone numbers, and all digital assets. You're going to want to make sure that you describe those things in your agreement with the seller so that you have account to transfer those over to you. Trade name. Maybe it's an amazing name that is so well known in the marketplace that you want to make sure you have that because there's goodwill associated with that name, especially a history-based business that's been around for 20 or 30 years. The name means something in the market and you're going to want to acquire that as well. And last is cash. Sometimes this is excluded. Most often sellers will want to take the cash on closing as part of their part of the business sale. And so you can negotiate it sometimes, but cash typically goes with the seller. But again, I said this a minute ago, I want to say it again. Make sure that in the agreement, it spells out every single asset that you have, that you're acquiring in this business so that there's no confusion. So this is the deal and the structure, financing, terms and price, things that you're acquiring. You want to make sure that all of this is spelled out and you are safe in your business acquisition. So again, this is Dr. Eric Scroggins. In the next video, we're going to be talking about closing the transaction, getting the deal done so that you can start working. It's going to be amazing. And I hope you are successful in your business acquisition endeavors.